Hello, welcome everybody, and thank you for joining us today. My name is Alec McCutcheon from UNICOM, and we're very pleased to be hosting today's webinar, which is on the theme of utilising sentiment analysis for effective asset allocation. I'm delighted to introduce our presenters and panelists today, who include Christopher Cantos, is Managing Director, Head of Quantitative Research at Alexandria Technology. Also, Professor Gautam Mitra. Gautam is the founder and managing director of OptiRisk Systems. And also Dr. Zurian Sadiq. Zurian is senior quantitative analyst and researcher, also at OptiRisk Systems. So the format of today's session, we're going to have two presentations by, firstly, Chris Cantos, secondly, by Gautam Mitra. And then we're going to open up for questions when Zurian's going to be joining for the panel as well. We invite you to put your questions into the chat box. You'll see a little bubble, I think it'll be at the bottom of the screen with the chat. Just type your questions in there as you go along, if anything comes to mind you'd like to ask, and then we'll endeavour to answer as many questions as possible at the end. So I will now hand over to Chris. Thank you.
Great. Thanks, Alec. Can you hear me all right?
Fine.
Okay, great. Let me just pull my screen up here. So thank you everyone for joining. To start the session off today, I am just going to be discussing using earnings calls, sentiment analysis in particular, for asset allocation strategies. So first, just going to review a little bit about Alexandria Technology, go through a few of the approaches for NLP for sentiment analysis of earnings calls, and then get into a little bit more of the asset allocation strategies. So a little bit about Alexandria Technology. We are a natural language provider. What that means is we analyze all sorts of financial text, including news, earnings calls, economic reports, social media, and turn that into structured data for systematic investors. One of the differences between our approach to NLP and a lot of others is that we are purely using machine learning. So what that means is we're not using rules, we're not using dictionaries, and we are not getting sentiment to price. Sort of the utility function of our NLP classification is to think like an analyst would think and interpret financial text like an analyst would. How we achieve that is we actually have human analysts reading the documents in question, news, earnings calls, identifying words, phrases, as well as sentiment within the text. That builds up the training corpus for our sentiment classification. We have found, and will show later in the presentation, is that this does produce results that are uncorrelated to your traditional risk and return factors, value, profitability, momentum, growth. So just to give a brief overview of the types of documents that Alexandria specifies for topic and sentiment. We started in 2012 with the Dow Jones Institutional Newswire, which we look at for single name equities, macro topics and themes, as well as commodities. We've since added to the types of data providers that we look at, Benzinga, Midnight Trader. We actually have a proprietary relationship with Nikkei to do native Japanese classification, as well as several different types of social media, Reddit, web news, blogs. And then finally, what we'll be discussing today is the earnings call database, of which we classify for topic and sentiment. That database, we partnered with FactSet in 2019, and it is well over, at this point, I think, 2 million different corporate events. It's not just looking at earnings calls, but also looking at different types of events, like if a company were to give a presentation at a tech conference, different types of sales calls and guidance calls. Pretty good global coverage. Today, we'll be focusing on a universe of US securities. So just to give you a bit of an idea on how the machine learning and NLP classification works, here is an example of a BP earnings call where the CFO is up discussing in two different sections. The management discussion section 39, refining environment also remains extremely challenged. BP's refining marker margin averaged 590 in the second quarter compared with 1520 a year ago, reflecting sharply reduced product demand and significantly lower industry refining utilization. So the first thing that we're going to do within this piece of text is identify a topic. And so the machine learning here identifies that this is about operations and product in particular. And then the second thing that we are going to do is calculate a probability distribution, whether or not this text is most likely to be positive, neutral, or negative. So we have that distribution here. And as you can see, the highest probability is negative. So we will apply a binary net sentiment score of -1 to this section. Each earnings call ends up being around 200 unique sections. From there, we also split it up between the management discussion and the question and answer section, just because we like to see where the sentiment is coming from. Is it agreeing or is it disagreeing? Just a second example here. Also, the CFO thinking about gas markets and a weaker economy has reduced demand and works in the pre-existing oversupply in the market. So here we have our topic being operations, commodity, and natural gas in particular. And again, looking at our probability distribution of sentiment, we see that the highest is negative. So we have two sections here that are negative for this particular BP earnings call. So we're going to create sort of an asset allocation strategy using all of these unique sections. So within the earnings call, looking at the management discussion as well as the question and answer. But before I get into how we're going to construct that strategy, just want to go through a few other different NLP approaches and see how well within these individual sections they agree with each other. So we're going to compare three different NLP approaches. The first being Law Firm McDonald, which is the first sort of financial lexicon approach, which was two professors from Notre Dame. We're also going to look at Alexandria's approach of using machine learning ensemble. And then finally, we're going to look at Finbert, or its Google model, trained on trillions of different tokens applied for the financial domain. Finbert is a deep learning model. So they were all trained on different language models, and the sentiment training was also quite different, which is what we will also get to a little later in the presentation. But for our analysis, we just want to see how well do these types of NLP agree when looking into data, and then of course, how well do they work for an asset allocation strategy. So when we looked at all of our earning calls, the individual section level, so that was like in the previous slide, section 39, section 40, we wanted to see how well did it agree on positive, neutral, or negative within the three approaches. Interestingly enough, we found quite low correlations for each approach. The lowest being between the dictionary approach and Alexandria's machine learning ensemble. I think the most surprising thing, however, was the highest correlation at 0.38 was between Law Firm McDonald, arguably the most basic approach, and Finbert, which of course is a deep learning, quite advanced transformer-based approach. Once we looked at all the individual sections, we went and aggregated at the stock level, and unsurprisingly, correlations rose, however, still remain quite low. And before anyone asks in the Q&A, yes, we plan to extend this for GPT in the short-term future. So this just gives some examples of how classification works and the differences that may arise. So here we have Google talking about their cloud segment revenues were 4.6 billion, up 54%. Revenue growth was again above cloud overall, reflecting significant growth in both infrastructure and platform services. And then at the bottom here, we're talking about a few different operating losses. And as you can see, Alexandria here classifies this as positive. Dictionary as well as Finbert classified as negative. And I think here probably, the most difficult thing with the dictionary or rule-based approach is it's so rigid. So even though in the top section here, you're talking about the fact that revenue growth was up and revenues were up again, it probably keys off of this word loss to classify it as negative. And then the second, turning to the balance sheet, spot assets were 1.1 trillion, with standardized risk weight and the assets increased to 454 billion, reflecting high levels of client activity and the closing of E-Trade. Standard CET1 ratio was flat to the prior quarter. Again, probably keying off words here like may not have RWAs, flat prior to the quarter. This shows you how these different classifications can come up. So getting to our asset allocation strategy, what we're going to do is look at every company in the S&P 500 from the period of January 2010 to December 2022. We're going to rebalance on a monthly basis. So on the last trading day of each month. And what we're going to do is look back 3 months. So what we're doing is looking back at every company in the S&P 500's most recent earnings call, and we're going to calculate a net sentiment based on that earnings call. So how we're going to create that net sentiment is first look at the MD, count the number of positive sections divided by the number of negative sections and take the log of that. Do the same thing for Q&A, and then we are going to just average the MD and the Q&A numbers. So every month we are going to have a different net sentiment value for every company in our universe. In this case, happens to be the S&P 500. And basically what we're going to do is rank them, split them into quintiles, go long quintile 1, which is the most positive earnings calls, and go short quintile 5, which is the most negative earnings calls. And here sort of is the performance for the Alexandria ensemble. You do see quite nice monotonic returns among the different quintiles. Then we get into all 3 of the different approaches. Block from McDonald gave us a chart over that entire period of 0.27, Alexandria 1.35, and Senberg 0.16. So what we look at the cumulative performance difference across that entire period. Alexandria was the best performing in all years except for the first 2. Even in this year of 2016, when everything was negative, still managed to outperform the other 2 approaches. I think the reason here for this negative year, I think that may have coincided with the junk rally. So companies were having really good earnings calls or very bad earnings calls. People were flocking towards the low quality names. So we realized that this wasn't necessarily an apples to apples comparison. If we go back to our comparing classifiers, our language classification and our sentiment classification were both done purely on McDonald was trained on 10Ks and 10Qs, Finbert on news. So one thing that we thought to do, especially because we were surprised how poorly Finbert performed, was to say, let's use our earnings call labels with Finbert and see if we can increase the performance any. And it got us about halfway there. So left us with a few more questions of, what else we could do to improve this number, but also showed us that there was a significant advantage to using our approach to classification and our machine learning techniques. So of course, this leaves us with some questions. So we want to say, how correlated is this to your traditional risk and return factors? And so we did look at a few different of the traditional risk factors, and judging by the low correlations, with the exception of a mild correlation to momentum, which is not unexpected, we see that we are having something of a different flavor here. We then wanted to look at several different factor models just to say, are we seeing any difference? So first we look at the Fama-French 3-factor model. Then we look at the Carhart, which is Fama-French 3 with momentum, then Fama-French 5 with probability and intensity, and then finally the 6-factor model, which is the Fama-French 5 with momentum. And as you can see, with these coefficients, we are adding between 62 and 74 bits monthly, pretty much showing that this survives the acid test, that regardless of the multi-factor model that we're using to measure alpha, it is adding value. And then to wrap things up, this has 2 lingering questions. Is the alpha constant over time, or does it suffer from some kind of regime effects? And then is there any signal of decay? And so to answer this, we looked at our 6th-factor model rolling coefficients. And while we can see here, this is the blue line, is our sentiment model. There is some oscillation, but shows that it is a consistent source of alpha. And finally, we're not seeing any signal of any type of decay of the signal. So that is sort of my portion on asset allocation using earnings call sentiment in particular. I thank everyone very much for listening and look forward to the questions in the Q&A.
Thanks, Chris. So hand over to Gautam.
Yep. Thank you very much. So let me share screen, and I share it here, and share. You can see my screen. Okay. Can you see my screen? Hello.
Yes. Yep. Looks good.
Okay. So let me put it out. So I'm going to, like Chris, present a bit about OptiRisk in one slide, and then I'm going to go over what are the research information or research results that we use, essentially outlining our USPs. What is it that makes our approach to asset allocation in some way different from anybody else for the moment, but maybe some others also use it that way. So let me just go to the next one. So OptiRisk is a financial analytics company. Its research is focused on the areas of management, of fund management, quant models, and AI and machine learning applied to BFSI sector. As researchers, we look for talent wherever it is. So they're in Australia, Brazil, India, Italy, Vietnam, and UK. Oh gosh. In the domain of quantitative finance, Optimus is an acknowledged leader. And for more info, visit optimistsystem.com. So you can go to our website and find it. Now, we first talk about the data, because as you know, today data is the king, and we have to make sure that we have the data available for past historic history, as well as for real time, as these being generated in the exchanges and is available. And so our market data of adjusted closing prices comes from Refinitiv, Thomson Reuters, whereas, as you can guess, because of a partnership with Alexandria, we take the news sentiment data from Alexandria Technology. We have been getting from other sources as well, but we have found Alexandria quite effective. So let's go forward like that. Now, now sentiments, as Chris was pointing out, are classified using probability of being positive or neutral or flat or negative. So any news event that happens or any sentiment that you can get out of microblogs like Twitter, etc., you can immediately get the, or rather, Alexandria provides you, and some others as well, a probability classification of being positive, negative, neutral, or negative. Now, we then apply the following transformation score, whereby we turn it into the range between -50 and +50. And when I don't expect to immediately get into it, but when you have a time, you can you get the recordings, you can ponder about it and say this. So it transforms to a real value between -50 and 50. And now we are going to talk about how the sentiment gets into impact. That will impact to the fund manager, to the market, and other parties. Indeed, we run a course on this topic. We are, as I mentioned earlier, an acknowledged leader in the domain of sentiment. We have published 3 handbooks like News Analytics in Finance, Sentiment Analysis in Finance, and now Alternative Data in Finance, about to come out with Taylor Francis. Now it's interesting that N alpha tau D is the news item where A is the asset. I'm looking at it, tau is the timestamp as we get from the data providers. And indeed, we don't do our NLP analysis ourselves because the data providers like Alexandria, as you just saw, are so advanced in this. So we profit from it. Now, we do densify sentiment score, as I just mentioned. So it becomes something between the value of, and D is the day there, between -50 and 50. Of the news item, N alpha T, tau. Okay, the impact of particular news item exponentially decays over time. This is a research that one of my PhD students did in 2011, 12 to 2016, and it found to be, at least in quant models, quite useful. So the impact score of can be given by the equation like this, that impact in alpha TD is sentiment multiplied by exponential decay, and for T greater than or equal to tau. It's best understood by looking at the next diagram, and we come back to it in a minute. So here it is. We have 3 news items we're looking at, maybe 2 days before, 1 day before. K equal to 1, there's a news item which is a positive sentiment. Then K equal to 3, 2 is a news item, but it's negative sentiment, the way we classify it. And K equal to 3 is another one positive sentiment. But we are interested current time T. So let's say T be 9, just for a sake. And what we do, we aggregate these impacts and come up with 2 separate scores of positive impact and negative impact. So if I go to the next one, you will see to obtain positive, negative news impact scores, we keep them separate because we don't know whether a particular news item, we don't know for sure which way it will go, which will the right false. If PID is the positive, the way I showed earlier, ITM, and negative can be negative here. Again, you can ponder a bit and see how this equation works out. So, as I said earlier, we have got two separate, if you like, USP. One is about news and news sentiment and sentiment, or news analysis, news sentiment from news text, and also sentiment from blogs and microblogs, etc. And we process them in the way just explaining. But we also have a special, I'm flipping, asset allocation strategy. It's called second-order stochastic dominance. Second-order stochastic dominance ranks the choices of random variables. Indeed, all portfolios are random variables. And, and it eliminates the need to explicitly specify a utility function. And the first-order stochastic dominance is driven by the two distribution Q and P. If probability of Q greater than X and probability of P, the blue one, greater than X, for all strictly greater, for at least 1x, then it is given as an integral between fpt minus fqt dt for all x, strictly greater for at least 1x. So if I may show you, there are higher order dominance, and first order stochastic dominance is very difficult to satisfy. So it is the second order, which in actual discrete distribution becomes, instead of integral accumulation, it's shown there. We have got various papers explaining this. So these are the distributional properties of what I just showed, a red and a blue portfolio. So we are looking at two portfolios, or whose has got to the random variables, as you know, its returns. And these are the two portfolios that are there. Now, what Markowitz will say, which is a two-sided volatility-based risk, is that blue is better than red because its expected return is higher, and if we can work out the variance, same or less. Now, what we do in second-order stochastic dominance, we look at the cumulative distribution of these two portfolios. And we have done a lot of modeling work. We are one of the leaders in this field, both modeling and also particular computational models by which you can compute them. For large asset universe, it can be quite challenging. But again, we have got a lot of published papers and white papers, you can see them. So this is what we do for asset allocation. So based on this, we make our asset allocation. Now, how do I do? I want to now introduce to you a technical measure, which you probably all know very well, called RSI, Relative Strength Index, which is really based on the concept of momentum. Now, it has an interesting property. Let me explain a bit more. You see, when you look at a portfolio and you're looking at how it's performing, if we say that tail risk is low, controlled, it's still a single period model. So, and that's same true for Markowitz or anything else. It is then what happens in the next period. But what RSI does, or momentum does, is to look at variation in the returns, and thereby it brings in dynamic risk measures or dynamic performance of the portfolio. And we'll see this as it comes along. So companies buying for stocks, recent gains, it's computed for each stock, relative strength index. It ranges from 0 to 100. And it's computed for closing prices for every asset. In our case, we take a position at the end of each day. It's a day trading, systematic day trading. But you could go beyond like 5 days or even up to 2 weeks or whatever. But for the moment, the results we show is for systematic daily trading, which can also be take position or even don't take position, but stay in cash. So RSI at a time period T is given as 100 over 100 plus 1 minus RST, and where relative strength is defined as exponential moving average of gains and losses for a period that will look back, like could be 2 weeks, 4 weeks. So you have to define that. And that also, this, as I mentioned earlier, brings dynamic aspect to the portfolios. Now, exponential moving average is computed this way. EMA, I said, so you can see the E. Now here comes the trick or connection with news or our news sentiment decay. So, this is fine. Now, N is the RSI period here, capital N. Now, news RSI includes something like EMA of positive impact and negative impact scores. So if you recall, I gathered the positive impacts, I gathered the negative impacts. So we define news, it's a sentiment indicator. So NRST is defined as EMA positive and negative. And therefore, exactly in the same way, NRSI is 100 minus this transformation, 100 over 101 plus NRST, and it's between clearly 0 to 100, between 0 and 100. Now we compute something called derived RSI. So let me explain again why. Because RSI helps you, if you are using the indicators, to identify stocks which will be using in your asset universe. NRSI, quite independently, might indicate stocks which may be useful in the asset universe. So we combine them using something very simple linear combination. We call it derived RSI, DRSI, theta RSIT and 1 minus theta NRSIT. And so you can see it's by a simple mathematical mechanism. You put theta equal to 0, you get NRSI. If you go theta equal to 1, you get RSI, something in between. So DRSI is RSIT, and you can see it's quite straightforward here, this part. Now, so then we choose asset portfolios based on this kind of filter. Actually, currently we're only using long only, but you could also use long short. And therefore we put them in some buckets. Again, in the domain of technical analysis, it's well known that if you have a RSI between the value above 0, then it is overbought, and sorry, above 70 is overbought. And remember that it's between 1 and 100. And if it is below 70, it's oversold. Now, if it is oversold, an asset, you want to buy it, which is why we put it in a long bucket. And then if it is overbought, then it's in the short bucket. So these are our test results. We'll show you. And then, sorry, we'll be talking all this time. We'll be open to questions from you. So we do market US and S&P 500, same as what Chris was saying. We have a full asset universe where we do apply SSD and see how it works. It actually works well. And then we do RSI and see how that works. And then we use DRSI and with value of theta. The example I'll give is theta is about 4. And we see how that works. And yeah, okay. So this is the result now. So if you see the result, let me point out, the red is the S&P 500 index. The blue is the full asset universe. And see the importance of SSD. It works really well, and it has gone up. And of course, it comes down, And indeed, some of the tests are like this. Okay, it's gone up over this year. But suppose you came in and invested here, you will all come down. So we do test with rolling time windows, etc. Anyway, So black is the blue is the full universe, access universe. Then green is the RSI. So RSI actually improves in the long only strategies. Clearly, it takes off at some point and it stays up and moves similarly. And finally, the DRSI, you can see, has even trumps that. So, and here is the, if you like, the traditional fund performance statement. So during this period, the S&P 500 went 1.69 when it came to that value, whereas full universe got to 2.51, RSI based went 2.56, and this went to 2.8. So it is what you get, the alpha, about the risk-free rate is this, 16.24, 16.6 is 18.85. Of course, you might think we have carefully massaged the figures and showing you all the time, but no, we do regular testing and we have learned a lot. And so the three scenarios are, one is black test during this period and with rolling window. Then the second one is actually in virtual environment, virtual trading. And finally, which we are done once before, but about to start again on actual trading. So you can see the risk-free rate. Then Sharpe ratio, you can see going up. Sortino is most important because it's tail, it looks at the tail, it goes up. And this is what I told earlier about dynamic risk. That means what is the maximum drawdown? What is the period? Okay, this is, you can see it's not that, it's better than the S&P 500. But then recovery days is important. So it takes 1 for 5. But here it is taking longer. It's true. But it's question how you supply your recovery days, you know. If you go back to the, you will see that full universe does take longer, but on the other hand, on every other measure, it's better. And this is the average turnover. So I think we have taken a lot of your time. So it's a time for questions. And you may put questions either to Chris, Alexandria, or to me and Zirian, and we'll be delighted to answer them. So over to you, Alex.
Thank you very much. Thanks, Gautam, and thanks, Chris, for two great presentations. As Gautam just mentioned, just a reminder that you can type questions in at any time in the chat box. You'll see it at the bottom of your screen, and we'll endeavour to answer those. Also, just a quick housekeeping announcement. We will be making a recording available afterwards. So if you want to watch this again or share with your colleagues and friends, it will be available. So I'll start out with the questions as they're coming in. One question is, can you sum up the strategy in a few lines?
Who is it addressed to Chris?
It doesn't say yet.
Yeah, to Chris.
For ours, yeah, it's pretty straightforward with our earnings call strategy. Basically, what we're doing is defining some look-back window, whether that's 3 months, 6 months, 9 months, 12 months, and creating a net sentiment score for every company in our universe. And then, we've looked at using deciles, quantiles, and basically just saying we're going to go take the long positions in our portfolio being the most positive, based on that sentiment indicator, and the short side of our portfolio being the most negative for whatever time period we're choosing.
Okay.
Thanks, Chris. Okay. And I've got another question coming. This is for Natam. Why only using RSI or the framework of RSI, where there are many technical indicators?
That's a good question. We have been playing with this for some time. We found, well, as I mentioned, with RSI, it's a dynamic measure. And because RSI is dynamic, by looking back, so we not only have single period asset allocation, but we bring into it the dynamism, and it also makes a list of those assets which have been either going up or going down. And so that is why you use RSI. I mean, the person asking the question can get more into this, and Zirian can can add something to it, and Chris, if you want.
Also, with regarding RSI, why only RSI? Actually, we have used other indicators. For example, Aaron, we use it with other sentiment score from other, from different sentiment providers. But RSI worked very well with Alexandria Technology sentiment data. That's why here in this case study, we use RSI.
Yeah, but RSI is actually with market data. The NRSI is with Alexandria Technology data, because of the news impact. So yeah, but yes, we found NRSI extremely valuable with that. No, Zirian?
Yeah.
Okay. Chris, you have anything to add?
I think to your point, while there are many different indicators, what you're doing is adding in something that is orthogonal, something else that hasn't been done with your traditional technical indicators.
Yeah. Actually, you are, now that you've started me, you are providing Reddit data, and you have now started using that. That's a very, very good information that we want to introduce. I mean, any more information that you get to, sort of predict, and predicting the market direction is a $64,000, or it's no longer much, it's $64 million question. That's what it is. And so, yeah, okay.
Thanks, everyone. I've got a sort of generic question here for me. Where does someone get more information regarding second order stochastic dominance, SSD?
Well, it has been well studied by economists and statisticians. The mathematical definition is fairly well known, and many textbooks and some domain experts, I can give you names after this, who can do it. But we have, from year 2000, have put a lot of effort in this. With a PhD student called Diana Roman, who did some work, both in terms of modeling and some about solving. As I said, solving is difficult. And then we had experts in solution technology. As you know, Opti comes from Optimum, which is optimization specialist. So we have also various published papers on that. So we'll be quite happy to share those papers. And they're also on our website, but you can, meaning the white papers, but we can provide the guided explanation if anybody wants.
Thanks, Gautam. And also following on from that, are you aware of any quant fund management companies that are using SSD for asset allocation?
Let me first of all turn it on to Chris, and then I'll have my views. I'll come to that. Chris, what do you think?
So for which question?
This SSD,
are you aware of any quant fund management companies that are using SSD for asset allocation?
Well, I think Professor Gautam, you might be the best to address this one.
Okay, all right. Well, I mean, it also says something about the fund industry, because when people use some special tools, they're extremely secretive. If it works, they wouldn't let it out. And there are various hedge funds and others have attended conferences in the last 5 years that we have done, where we have been peddling or pushing our second order stochastic dominance. And I'm sure they have got quant team members. It's easy to untangle to reverse engineering. They're doing it, but I'm not 100% sure I can put my finger on one and say that this one is using SSD.
Okay, thanks. Another Slightly different question. What's the big deal about using RSI indicators in asset allocation?
You're
The big
coming
one.
to me. All right. The big deal is what I mentioned earlier. It is to control the dynamic risk. It is to look at, it is to make up a list of assets and the asset universe, which have been performing by going up or going down. And then we put it into asset allocation strategies of oversold or overbought or oversold. At the end of that, you're able to create buckets, meaning, say you've got SP 500 assets. You make up the top, oversold asset, meaning list, come to the bottom of the 70, less than 70. And that, say you take 30, 40, and that is a good set of assets to make an universe and go long on. I mean, the whole point about RSI is that of identifying, using momentum, dynamic performance of each asset.
Thanks, guys. So I don't know, Chris or Zuin, if you want to add to that, or
There.
Not really.
okay. So
Chris,
one more. Sorry.
Let me ask Chris. Chris, what do you think? Have you used their RSI in your fund management or in your advice?
Yeah, I mean, we've certainly, when we have sort of clients coming to sort of explore different ways in which they can leverage data, well, that's certainly one of those things that we pointed in the direction of as something that has been proven as a useful and effective way to use this data.
Good. Okay.
Got a question from Hugo. Is the decay effect of news the same for positive sentiment and negative sentiment? Sure, who'd like to take that one?
Yeah.
Yeah.
Yes. Well, as you can see, our idea, okay, let's think outside the box. So what it is, we found a news item that has a positive sentiment. So what happens? It keeps being repeated or sort of reported on other media, and its effect keeps decaying to positive. So if it was 50, which is what we are between 50 and minus 50, it decays, and after some time it goes to minuscule value, like something that happened 2 years ago has no effect right now, like Volkswagen calling their a particular model, etc. And same with negative. That's an example of a negative one. You had a negative impact, but over a period, the negativity of that impact decreases. Or in effect, what I showed, if I may go back, am I showing the slide still?
Yes, you
yeah.
are, Gautam. Yep.
Yeah. So here is decaying to positive, to low value. And here, negative effect is, in a way, the way it looks is up, but it's very negative and is relatively negative. So yes, that was our thesis of being using the decay function for the impact. Hugo, anything else you want to ask on that or your comment?
Hugo
Yeah, I
says
think
thank you.
I have a little bit to add on that from our sort of analysis. Even just taking a step back, there is a lot of academic literature about like investor reactions and asymmetric behavior to reacting to positive news versus negative news. I think the paper was Brown, Harlow, and Tinnick in '88 who first looked at this. And this is especially amplified like in bond market. where good news, you're going to get repaid, and bad news is really, really bad. So there's that. And then that was sort of more kind of geared towards looking at news. Interestingly enough, what we found in our analysis was that as you go out to longer holding periods, like looking at earnings calls is of course a lot different than looking at news. News has a much quicker decay ratio. Price going to decay much quicker. Earnings calls tend to be more forward looking. So speaking about the future. So what we found was actually the signal actually gets the strongest at around 1 month holding period. And then interestingly enough, as you go out to like 3 months, 2 quarters, 3 quarters, holding periods even, we found that the long side of the sentiment indicator stayed pretty consistent out from 1 month to 9 months. Interestingly enough, the short side, so going short, the most negative earnings calls companies actually got a bit stronger as you went out to the longer holding periods. So, different types of news are going to have different types of decay, even on the long and the short side.
Thanks, Chris.
Mhm.
Okay, so I think I had another question from my notes, if I can put it to the panel. In the fund management industry, are news analytics, sentiment analysis, are they well accepted and routinely used, would you say?
I can start with this one. This is kind of an interesting question, especially towards Alexandria. When we started in 2012, it certainly was a lot more difficult to go in and say, hey, you should look at sentiment analysis. We're doing this thing called NLP. And of course, everyone kind of looks at you like you're crazy. I would say times have definitely changed substantially. Investors are looking at all sorts of alternative data sources, and I think sentiment is widely regarded to with something that's now quite universally accepted. Gautam, your thoughts?
Yes, actually, it's interesting. If you look at what's evolved, as I said, news was the text analysis, and then microblogs like Twitter and Reddit is analyzing the short text. So there's certain technology there which people have been using it, and it gives them a payback. And indeed, I'm sure I talk to many of these. Like you probably go to a potential bar of the data, your special data, and they talk to you about want to be satisfied that it really does make some difference. And indeed, they have quant teams who do this. Now, why am I saying this? Because the whole thing is evolving. Now, most of the data providers like you or Ravenpack or Bloomberg, etc., call themselves alternative data providers. Because in addition to news and sentiment data, or actually the other one very important is the macro data, macroeconomic announcement. Those are, we didn't touch them today, are also there. But in addition to those, things like, footfall or AFall of cars in shopping malls before COVID, or now all this chatter over mobile devices, cell phones, are being used, analyzed and used. So there are people who are intermediaries, aggregate them. In this quandle used to be one which S&P now bought out. But my thoughts are that the whole field is evolving. And it's just not because, this is for academic interest, but because it is having a payback in terms of alpha. What do you think, Chris?
Yeah, I mean, I would definitely agree that people are figuring out ways to use this data and finding that it is, as I mentioned before, orthogonal. The way we look at it is it's all about marginal contribution. So if you're looking at this and saying, okay, this is actually adding something above to all the other factors that are going into my alpha model, we seem to think, and a lot of others do as well, that this is a significant source of marginal contribution and orthogonal alpha for investors.
Yeah, absolutely. I mean, if we go back to the basics of economics and finance, if we recall, because finance from economics, there is so-called EMH, former in French and former what is Nobel Prize recently. EMH stands for EMH for efficient market hypothesis. So in theory, all this information that we're talking about, the market digests. So what's the big deal? The big deal is in the interim, in the short period, you can use it to take advantage and find alpha. So it's all this thing is that on a short period, at least, daily or weekly or monthly, you can get some advantage out of it. Chris, what do you think?
Yeah, I would wholeheartedly agree with you on that.
Okay.
Well, thanks for answering that so comprehensively. I can see another question that's coming. We've still got a couple of minutes left. Do you think this can be used for trading in shorter timeframes, such as intraday trading?
I'll be happy to take this one. Yeah. So as I mentioned before, things like earnings calls are very good for sort of like longer holding period strategies. But looking at things like news, which are available in almost real time, we certainly have seen people implement strategies at very high frequencies, by the second actually. So we actually provide our data via like a real-time API. So as soon as a news article is published, we classify it for topic and sentiment and push it to the users. So you would actually be able to, in near real time, build out high frequency strategies with sentiment data.
Yes, I could add something to this, because nowadays the earnings calls are actually discussed over telephone, right, or some other information sharing facility, and that is sort of awaited with bated breath by investors. Also, certain type of information, particularly every quarter, you get macro information of purchase managers' view of the market. It's very much awaited, and people, because it's giving summative view of good collection of people, meaning, if you like, analysts in the market, it's extremely valuable. And indeed, there were some questions that when it comes out, is it being given out to all corners of the world similarly, at the same time? So it's really market data, but not entirely market data. Sorry, it's really sentiment data of macro information, but its immediate impact is quite substantial. What did you say, Chris? Chris?
I think you're absolutely right. And being able to quantify it quickly, of course, gives you an edge, sort of in the market to using this type of data.
Yeah. Actually, macro data is very important, and each country has its own also some kind of equivalent to macro data, like central bank's announcement of the interest rate, and that has an immediate effect as soon as that happens. So anyway,
Thanks, Chris and Gautam. I can see one more question coming. Actually, I was waiting for this one to come up. It's very topical at the moment. And that is, how can Chat GPT be useful for analyzing news sentiment? This is from Hugo.
Yeah, so we clearly get this question quite a bit. Like, are you looking at ChatGPT? Will you be looking at ChatGPT? And I guess my initial reaction from sort of reading the papers and doing our own type of analysis is that like things like ChatGPT and Bloomberg GPT, while they are certainly game changing, are going to be maybe more jack of all trades, master of none type of workflows. So, you know, they are trained on just this incredibly broad set of information. We've looked at perhaps maybe using ChatGPT for something like document cleanup, things like that for sort of types of analysis. And I believe there are already some white papers on analyzing trading strategies using ChatGPT. So as Gautam mentioned in his previous answer, this is a continuously evolving market, especially with the GPT arena. Every week there's something new coming out. So, you know, it's difficult to exactly say what's next. Well, we always try to, as mentioned, like looking here at Finbert, keep our finger on the pulse of what's happening and seeing how things can possibly be utilized to add value.
Great. Yeah. Actually, let me just, I think we should be coming to an end soon. There was an article literally 1 week ago in FT where the Financial Times explained that a group had used ChatGPT for simply fund management and compared it with various fund managers, you know. And it seems that it has come out tops in all types of different funds. One of the great advantage of ChatGPT or the GPT is it has got enormous access to the data. The amount of data and the computing power it can process. And now that you have this GPU people, I forget the other name, who are very big, you know, they're enabling ChatGPT to go, is NVIDIA, yeah, NVIDIA, is quite mind-boggling. It, you know, bypasses us all, you know. And so watch this space. I mean, there is definitely going to take off. Question is how a quant person or a quant researcher or a AI and machine learning researcher can use it, understand, use it, and harness it. So you can always add to it, you know, understand that. And so, in my opinion, don't ignore it. Can, you know, put some, as Chris says, their team are doing, put special effort in this. Okay.
Well, thank you very much, everybody. I think that brings us to the end. So, Chris, Gautam, Zurian, thank you very much indeed. It's been a great session, and thank you everyone for your questions. That's been a fantastic session, lots of interaction. So just a reminder, we will be making a recording available. We'll send you the link shortly. And again, a big thank you to our panel today. Thank you.
It's been a pleasure.
Thanks, everyone.
Thanks.
Thank you.
Bye-bye.
Bye. Bye.
Bye.
Bye.
Bye.